experience with accounting? Yes. What kind?
I take accounting classes here at Dominican.
Are you taking? What are you taking? Financial or managerial?
I'm taking financial, managerial, intermediate one, and income taxation of individuals.
Because you're accounting major, right?
Yeah.
Okay. Anybody else taking an accounting class so far? What did you take?
I just finished Accounting 101.
What do you think?
It's okay. It's just like very much, but it's like debits or credits. That's kind of the part that would mess me up.
Oh, okay. It's
Yeah.
kind of. Why did you choose accounting?
It just seems like a really useful discipline to have no matter what you do with your life or professionally. I'm not necessarily locked into being an accountant, but anything I do definitely gonna need accounting skills, moving money.
So the knowledge can be multidisciplinary. It can apply to different things. Kind of
Yeah.
way of looking or viewing at.
More so than other business degrees, in my personal opinion, as an
Yeah.
accounting major.
Anybody else want to go into a major?
I'm not trying to business, but you need some accounting expertise.
I mean, you should have an understanding of this, the basics, right? You should. I mean, you can always hire somebody.
That's until you get to that point where you can hire somebody.
Yeah, yeah, you should understand just the basics, and which we'll talk about. We'll talk about some of the basics.
Weren't you an accounting major in the past?
Yeah.
What were you?
International business. My MBA is international business. My undergrad is marketing and management. So start off with marketing and management. I kind of delved more into finance, so
Oh yeah,
dealt with a
I think
lot
you said
of
finance was.
yeah, I dealt with a lot of accounting practices and stuff like that. Accounting was too boring. All right, in this chapter, we're going to define accounting, describe accounting information is used by a variety of stakeholders. You got to identify the purposes and goals of generally accepted accounting principles, or GAAP. Describe the key elements of the major financial statements. Anyone here ever looked at financial statements before?
Mm-hmm.
You have? Where?
Work, my own, depending on what I'm currently.
Okay. So yeah, maybe you have some personal financial statements you over time take a look at. Bank statements, credit card statements. Anyone else? Financial statements. Hmm.
Personal vehicles.
Just, okay, so you like to manage your money, take a look at it, see what's coming in, going out, expenses, etc. Okay, good. Which kind of same theories apply here? So we're going to talk about some methods stakeholders can use to obtain useful insights from a company's financial statements, and explain how budget process can help managers plan, motivate, and evaluate their organization's performance. And explain the role of managerial accounting and describe the various cost concepts identified by managerial accounting. So what is accounting to you? What's accounting? Okay, managing money. That's one definition, one description, I would say. What else?
I used to think that's for just expenditures or something.
Okay, well, maybe partially, right? Partially for expenditures. When you think of accounting, what do you think? All right, maybe data or data/information, right? So it's useful for describing, reporting, analyzing activities. Think of activities in the business, right? A transaction, new debtor, creditor, what have you, right? So we say it's a system. Accounting is a system for recognizing, organizing, analyzing, and reporting information about the financial transactions that affect an organization, right? Everything that happens within a business is really a transaction of some sort, right? You buy a new piece of machinery, you sell it off, you report it on taxes for depreciation, you take out a new loan, someone buys something at a business, right? So another transaction has happened. So we have transactions that are constantly happening, and accounting is there to tell a story, right? So really when you look at statements, all you're looking at is a story, right? You could look at the story of, hey, this company, from what it says on this report, it looks pretty good, pretty successful, right? If you know how to read the story correctly, basically. So we also needed to be organized to see, hey, the snapshot of how things are going, right? So depending on a particular statement, we can see how one particular area of the business is going. How is our debt going? Do we have too much debt, or what we would call obligations, right? You have too many obligations that you can't fulfill. Think of it on a personal level. You may have credit cards that are $300,000, $500,000. You max them out. You don't have the money to pay it back, right? So you're not able to fulfill your obligations. Therefore, the credit card companies, or credit companies in general say you're too risky, right? You're not doing well financially. You're not in a healthy financial position. Because we're looking at this story, and the story doesn't look too great, right? And then another creditor may look at someone else and be like, oh, you pay on time, you don't maximize your credit cards, you don't use up all the money, right? You have like minimum balances. And so that story is different. The thing is, it's about to tell the story of the health or position of either individual, right? But here we're talking about companies, and large companies at that. So we gotta have a system for recognizing the information, organizing the information, analyzing it, and reporting it, right? We have governments that need us to report. We also have people who maybe own the stock, and they need to be reported to be like, what are the transactions, right? How are we looking right now from a mathematical point of view? So here we could look at, hey, are things working in terms of us meeting our goals? Looking at this information, are we meeting our goals that we set forth, or are we not meeting our goals, right? And some of the goals here for just having accounting is to provide users of accounting information with relevant, timely information that helps them make better economic decisions. So you have to make a decision based on what you see in these reports, in these financial statements. So you want to make sure they're pretty accurate as well too. They're timely, they're relevant, right? You don't want to be reading stuff from 2 years ago, a year ago. You want to be reading things that are up to date and show the current health and status of the company. All right, some people who use accounting, right? Major ones are managers. Managers are the ones that oversee operations of a particular business unit, and they have to look at the numbers and say, hey, what kind of changes need to be done right now? Do we need to hire people? Do we need to move around more people? Should we eliminate some machinery? Should we buy more machinery? Should we take on more debt? Things like this, right? So here they're saying marketing managers require information about sales and product lines, and financial managers require up-to-date facts about debt, cash, inventory, and capital, right? So one way that marketers will say, hey, you gave us this immense budget, right, for marketing, to all the social media stuff and print ads and all this stuff. Did it translate into something worthwhile? You could clearly see that if you say, hey, from last time, our revenue has grown. So clearly the marketing has worked, yet we have more sales, right? If sales have been the same, and you've had this big budget, our sales are the same, or our sales are less, you're like, no more big budget for you, right? Or you need to be fired because your marketing plan sucks, right? But we could look at that and say, hey, this actually translates to something worthwhile, right? That's kind of how the marketing manager would see it. And the financial managers would look at it in terms of, hey, allocating budgets to specific parts of the business, right? So they say, hey, okay, well, marketing, we can't give you that budget because we don't have that type of money right now, right? Or we have too much debt right now we need to pay off. Someone in operations will look at like inventory and say, hey, we have way too much inventory on hand. We need to eliminate some. And then we get capital. Hey, we need to take on either more debt, right? Leverage it, maybe buy a new building, new processing plant, a new manufacturing plant, et cetera, et cetera. And And then stockholders require the firm's financial statements to analyze its financial performance. So for the people who own stocks, what are some of the reports you could pull up being a publicly traded company you could look at? Do any of you ever look at the reports for some of the stocks you own? Who here owns some stocks? Do you look up some of the reports?
Every like few months or so, you know, the stock beta, any statements the company makes.
You say you're looking at beta and things like that?
Yeah.
Okay, so you're looking at the risk of the stock, volatility, how risky it is. But you know, publicly traded company, they have to be extremely transparent. If you're a private company, you can do what you want to do with that information, right? It's not out there. But publicly traded companies, all this financial information has to be out there so that the stockholder can clearly see the direction this company is going and actually how healthy it is, right? And so at the end of the day, on a lot of these reports, you get like 10K reports, which are really, you know, big ones, like 100, 200 pages. At the end of the day, it'd be kind of a summary, kind of show like what's doing good, what's doing bad, you know, what are we gonna do about it in the future. And then employees can make use of accounting information to determine whether a firm is financially stable or not, right? If you become an employee of a large organization, most likely you'll have a pension plan, right? You may have some sort of profit sharing plan, so profits are going down and they're not gonna share much with you because the money's not there. Are they gonna be able to supply you with all the health insurance you need? Will they provide stock options? All these different things, right? So before making a decision on where to work, you probably wanna look at some of the financial statements. If it's a publicly traded company, you can get that information. If it's not, you can't really. But if it is public and you go and work for them, you could look at this information and say, how financially stable is this organization? All right, like we say, just like as an individual, creditors require information to assess firm's creditworthiness by looking at its financial statements, right? So you go apply for a house, right? Anyone here own any property right now? Condo, anything?
Yes.
Well, I always do that. Okay, what are some of the things they ask for? The creditors, right? They're gonna give you banks are gonna give you a loan or a mortgage. What's some of the stuff you think they would require?
Well, so let's say your credit history is one of the 29 things that they looked up.
All right, so let's say credit history. You're gonna say, hey, let's see, maybe last 2 check stubs, right? You wanna see how much you made? Maybe more than that. Maybe you wanna see the last 3 months of check stub.
They check the year for me.
Yeah, they probably do. Typically, they wanna say,
I'm so young.
yeah. Well, let's just say they wanna see the last 2 years of work history, right? You should have been at this job for 2 years at least. If not, we don't, you know, that way we think you're kind of built in. You're not gonna quit anytime soon. We'll make that assumption. Your credit history, right? How long have you had credit cards out? How much do you utilize them? Credit utilization. You like, hey, do you max out your cards every month? Man, that's kind of risky. That means you really don't have the money, right? Do you pay it on time, right? Your debt to income ratio, right? How much you actually make from your job versus how much you have to pay a month in obligations, right? All this different stuff. Same stuff apply here. So creditors will look at a firm's credit worthiness to say, hey, you make X amount of dollars in revenue, but you do get X amount of dollars in debt, liabilities, right? Maybe the machinery is on loan, right? Maybe you are renting this space, you gotta pay that, utilities, insurance, all this stuff. So at the end of the day, they're gonna look to see, are you worth what you're asking us to give you? If not, maybe we give you less, maybe we give you nothing at all. Right, and then suppliers require the information to know that the company can pay for the orders it places. You know, if you have a built-in relationship with your suppliers, you probably have a credit system already in place, which means they're just gonna constantly supply you with what you need, and you probably pay them sometime in the future, right? Maybe it's on you pay them a month later after when you actually get the stuff you needed from them, right? And so if they're gonna have that type of relationship, they wanna make sure that the company is able to have the money to pay them like it says it's going to. And then we got government agencies, right? So the government acquire the information for meeting the reporting requirements of the IRS, the SEC, and other federal or state agencies. And the SEC controls pretty much and looks over all of the publicly traded companies. So they have a lot of guidelines, a lot of reporting that they have to meet, these companies have to meet. All right, some rules of accountants, right? They provide services such as tax preparation, external auditing, or management consulting to clients on a fee basis, right? So you may need to hire an accountant, because maybe you don't have the time to be looking at all this information. You don't want to make too many mistakes. Remember, we say the more mistakes on your accounting reports, that means you actually can't make good decisions, right? Because you may think you're doing a lot better than what you're actually doing, or you may be doing a lot better than what you actually think you do, right? Thus, you want to have concise information so you're able to make better decisions. And then you also want to maybe save on taxes, have write-offs, all sorts of things. Or do you also want to see things like employee theft too? So think of that, you got people working for you, but you could be skimming off the top, stealing stuff, and so you kind of do audits from time to time to make sure that everything's on the up and up. And then we got management accounts, right? Work within a company and provide analysis, prepare reports and financial statements, and assist managers. So these are all the people who are going to do the reporting. And look at all these reports and bring it to the meeting. And from there, the people who make decisions within the company look at this information and say, well, why is this number so much? Why is this number so little, right? Why did this number grow from January to February? Why did this number go down from March to February? All of these things on the financial statements to say, what do we need to do to change? Then we got governments, accountants who perform accounting functions for local, state, or federal government agencies. Each state has like controllers and stuff like that. So they got people who manage the financial budgets of the government, right? Government takes all that tax money from us, right? Sales tax, income, real estate. And so they also need someone to manage all this money coming in, to make sure everything is proper. And so financial accounting is a branch of accounting that prepares financial statements for use by owners, creditors, suppliers, and other external stakeholders. Think of it, if you're just an owner and you don't really, you're not hands-on in the business, you're just, you're retired, you're somewhere off, you're gonna make decisions by just looking at reports all the time, right? You're not gonna be there physically to examine everything, so you wanna be there to just look at some of these statements. Or if you're creditors, you'll have to constantly revise some of your lending practices with a firm based on where they financially are, and suppliers, and we said stakeholders. And the stakeholders need this information to analyze the financial condition of the firm over a period of time. Also think of it too, this stuff is important if you're going to invest in a company, right? If you're properly able to analyze the income coming in, the cash flows coming in, the amount of debt the company has, and how much they've grown from one period of time to another, as opposed to just the stock price, right? So people are just constantly looking at the stock price without looking at the information behind it and saying, hey, this company's on its way out, right? And then we got GAAP, right, which is generally accepted accounting principles. It's a set of accounting standards used in the preparation of financial statements. So it's kind of just generally accepted rules of how to do financial statements. Make sure everybody's kind of on the same page for ethical purposes. Right? And then we got Financial Accounting Standards Board, or FASB, and they are a private board that establishes the GAAP rules used in the practice of financial accounting. Right? So they're the ones who are sort of retired accountants, been doing it a long time, government accountants, and they kind of set the principles. All right, so through GAAP, the FASB aims to ensure that financial statements are relevant, right? They provide relevant information, they're useful, they're reliable, meaning that they're pretty accurate, they're consistent, right? They don't change much over time, and they're comparable. Comparable means that you're able to analyze two different companies within the same market and industry, and it should be able to be quite easy to do. All right, balance sheet. So we're gonna get to some of the reports, okay? Balance sheet. Who here has come across, well, besides my company, what do we think balance sheets are?
It shows the expenses, the income. It just pretty much lays out everything across the board in front of you.
All right, yes, pretty much, right? Three things. Assets, resources owned by a firm. And when we say assets, we're really, sometimes assets gets sort of a misnomer, gets confused, right? So we say something that has a future value to it. That's what typically would be an asset, right? In different areas, assets are kind of different. So someone would say, hey, my car is an asset. Could that be true? Could that be false? Someone says, hey, my car is an asset. Here's my asset.
If your car is essential to your business,
It's an asset. Okay.
transportation, delivery service, multiple things. So car could be an asset to, let me take Uber for example. Your car would be an asset.
So in a business sense, you said if it contributes
Exactly.
to the business operation, it's an asset. What else? How could it be an asset? How could it not be an asset? Yes.
It could be a liability if you're still paying off the car or the machinery into the future.
Yeah, anyway, so liability, it could be a liability because the transaction hasn't been settled, right? You owe the bank, that's why you're paying your car note, right? It's not your car, you can't take it and sell it. What we said, future value, right? Something that you have that has a future value to it. Only future value you have if you're financing a car, the bank has the future value, not you, right? It's paying. Now, if you say, hey, I own the car, then you say, yeah, it is an asset in some way. If I own it, I pay cash for it, right? There's a future value to it, minus how much it depreciates over time. Right, on the side note about cars, how much new and used, what makes a car, what's the difference between new and used car?
Used is cheaper, but also has quirks in it that diminish the price.
Okay,
Used out of the factory is not anymore.
okay, who else says something different?
That's it. Yeah.
New car, used car. Right, difference between new and used is, has it been driven off the lot? What's the difference between 5 miles on the car and 50? Well, I got 50 miles on this, a certified used vehicle. It's still new. You get what I'm saying? So a lot of times this stuff is a play on words, obviously, to get people to pay a lot more money. It works, because people believe in it. Used car could be something with 500 miles on it. Right, that's not used, that's brand new. Right, so sometimes it's play on words. But that's just a side note. So once again, it's something that has a future value. Future value. Now, a home may be an asset, right? A home may be an asset. It's a guarantee that it is, right? Maybe if you could sell it, if there's a guaranteed way that you could sell it to actually make more than what you owe the bank, okay, maybe it's considered somewhat of an asset. If you have it on Airbnb, it's an asset, great. Typically, really an asset is something that makes money, if you have a car, you say, I just drive to go places, that don't mean it makes money. It wouldn't be considered an asset, it's just a liability, you just pay on it, right? You say, I use it to drive Uber, it's like, okay, that's quasi an asset, right? Somewhat, it makes me money. Your house, you Airbnb it, you're like, oh, house makes money, and I own it too. Okay, great, that is an asset. But here what you're saying, here they're making it simple. They're saying resources owned by a firm, right? When we say ownership counts, own, right? And then liabilities, claims that outsiders have against the firm's assets. We say, hey, all right, you don't own that piece of machinery. Remember we loaned you the money for it, so you can get it. You don't own that building that you have your restaurant in, right? So you have a landlord and he owns it, or a creditor owns it, right? So basically it's debt, right? And then we say owner's equity, claims that a firm's owners have against their company's asset, which could be a percentage. Maybe you don't wholly own it, right? If you say, hey, I'm a publicly traded company, does that mean somebody owns it 100%, one person? No, that never happens, right? Or rarely happens. Because that means everybody who owns a stock owns it, technically. You own a stock in Apple, you go walk around and you say, yeah, I own this place. If you go into the Apple stores, right? You actually own equity in Apple, just like any other share, just like the guy who started Apple. He just owns a lot more than you. That's just the only difference, right? Microsoft, Bill Gates just owns a lot more, and maybe majority owner, but you still can own stock and say, I'm an owner. I own part of this business, part of this company. All right, and so those are the claims that the owner has against the company's asset, depending on how much they own in the company itself. So the owner owns, 50%, and now the business is gonna liquidate, sell itself off. Owner says, all right, sell all this machinery, all this property, all this manufacturing, fire everybody, make sure I get 50% of all that stuff. That's just essentially what's gonna happen, right? Owner's gonna say, I don't own 100%, I'm gonna get 50% of all this money back after we've liquidated the company. And then income statement, right? Reports their revenues, expenses, and net income that result from a firm's operations. So think of income statements just simply money gotten from the operating of the business, right? Money that you've got from operating this business. That's what the income statement will show. It also will show some expenses and your net income. What's another word for net income?
Profit.
Yes, right? So when you hear profit, typically saying net income. That's all it's saying. After we pay everything off, right? Net income will be what you got left. That would be profit. Sometimes it gets a little tricky because they'll put it in their earnings before interest and taxes, like they want to include interest on loans, taxes, and things like that. But to keep it simple, it just means net income. So you can look up a company and say, hey, what's the first number I'm looking at? Right? Net income. That's all you gotta say, how much profit. And if we look up a lot of them, we're like, man, a lot of them are negative 300 million. Net income. Like, wow, you that much in debt? No. Let's look this up really quick. Large corporations and the most debt.
If you look up the Apple one, the Apple exchange is way different.
Most indebted companies in the world.
Apple should be something else. I swear.
All right, Oracle. Anybody familiar with Oracle?
Isn't that like a search engine for out there?
Database management. All right, Hyundai. Right? Hyundai. On the surface, you drive out, you're like, oh my gosh, so many Hyundai cars. They're killing it, right? They're killing the game. Right? They're competing, they're doing awesome. But then you look a little closer, you're like, oh wow, the total debt of the company in the last financial year, 82 billion. That's a lot of money, right? They owe, right, well, we'll just round it up, right? They owe $83 billion. Right, so remember what we said, when we look outside and we drive around these places, we see the restaurants, we see the clothing shop, we see all these places. Remember one thing is key, like yeah, people come in and out, people buy stuff, they make revenue. They probably don't make profit. And that's the difference. That's why it's saying it's so successful. Yes, you got a business, anybody can have one. Anybody can start a business, right? Starting a successful business that keeps going up in profit, that's a whole nother story, right? That's completely different than just starting a business. And so you have to really figure out, that's what I'm saying, like as you become a business person, what's your key, I would say, key mind frame is change. How do you manage change? Right, there's a whole course we used to teach in psychology called change management. It literally just deals like how do you emotionally, mentally, cognitively deal with the change of the world. You're getting older, times change, people leave, people die, get fired, get kids, blah, 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 right? All this stuff. How do you deal with change? But this applies too. So you say change management. How do you manage change? Right? Your consumers are different. Maybe they've gotten older now. You got to get a new target market or something like that, right? There's constant change. So if you can manage that change, you'll effectively be a good CEO. If you can't manage how things change in a business, no, the business will suffer. So yes, total debt 83 billion, right? And then right here we have, what is this? Benayish Motivin Werks Achten Gesellschaft, German. What's that? You've seen this a billion places. Huh? No.
Is it beer?
No. Bavarian Motor Works. Acting Gesellschaft is just like a public company in Europe. What's Bavarian Motor Works? What's the acronym for that? BMW, right? BMW, $88 billion, right? That's the total debt of the company in the last financial year. So once again, hey, so when you're looking at that, hey, I want to invest in this company, first thing you would think of BMW, yeah, of course, you should invest in BMW, it's doing great. You're like, no, it's not. They owe $88 billion, right? So what I'm saying is these financial statements are extremely important because they tell a real story, right? Not all that glitters is gold, basically, yes.
So none of these companies have to pay it off. Probably no chance they will pay that off, but.
Different things happen. Either another parent company buy them out, right? I think at some point maybe we'll talk about like mergers and acquisitions, leveraged buyouts, hostile takeovers. So how could they get out of debt? Somebody, another parent company will say, hey, we're gonna take over, we're gonna pay down the debt, and then we're gonna restructure BMW. You know what I mean? Maybe we're gonna eliminate the plant in Alabama and put it somewhere else cheaper or something. But there's possibilities that they can make money. Maybe they come up with a more successful model of vehicle next year, right? Yeah, slow that down. And don't forget, like that. The creditors are going to come at them to pay it off, but they have lots of ways to pay off the debt. You know what I mean? We're just saying their performance as a company is not working too well versus their debt. Anheuser-Busch, right? So we're looking at beer, right? Biggest alcohol manufacturer in the world and currently owns 630 beer brands in 150 countries. They owe $89 billion, right? Shell, gas station, right? So you drive past a Shell, you could just say to yourself, oh man, that sucks, they owe $90 billion.
No, you just said. That's why I said professor.
Mercedes Benz, which I own a couple of them, but they're not doing too good. You know, but there's reasons why. You know, there's a lot of reasons why. Part of the reason is you see a lot of car manufacturers up here because the strategy for vehicles doesn't work everywhere. Eventually, the vehicles get cheap. So for Mercedes-Benz and BMW in particular, right? If you go buy one, there's one question to ask. Was that one made in Alabama? Was that made in Germany, in Bavaria? And if you get the one that's made in Alabama, like it should say there on the inner tag, on the inside door, you know, really that car might fail a lot quicker than the one, the same exact one, same year, same everything, as the one made in Germany. Different standards, different models of how you put that car together, right? So you can say it kind of got cheapened out. So that's how you kind of see that with the luxury auto manufacturer. Comcast, right? Taking all of our money for high-speed internet and cable. They owe $95 billion. T-Mobile, right? They bought out Sprint. Maybe they thought that would help. But maybe this is also because they took on Sprint's debt too. So we bought them out. You buy out a company, you buy out their debt too. Whatever they owed in debt, now you owe that too. General Motors, $110 billion. Amazon. I don't think Amazon has to worry about the debt, it's just there. And remember what we say is sometimes companies keep the debt on books, it's called get debt. So just like for you as an individual, it's not wise to use your credit card balance more than 30% of what they give you. It will impact your credit. So you said, what's healthy debt? What's actually gonna help me build my credit score, credit history? Right, just to keep 30, just to utilize 30%, right? Keep 30%, right? So sometimes companies take a debt strategy too, like, hey, whatever we owe, we only pay X amount back, because we want to keep kind of 30% debt there, because for our operations and performance, that number works best for us to continuously grow, but also still have good relationships with our creditors. And Apple owes $120 billion to its creditors.
It went up since last mentioned.
Well, pretty sure it'll keep going up. Ford, Deutsche Bank, which I have several loans with them, but they owe $156 billion. So anyway, not all that glitters is gold, and depending on where a company is, right now as we speak, should dictate whether you should invest here or not. You know, just because it has a big name, doesn't mean it's a wise decision. Any questions? Yes?
So these big companies, they kind of keep debt, is it for also tax write-offs, or is it only for them to pay it off at a small amount so they know they will pay it off, but they don't have to use a sludge sum of money each time?
Yeah, I think it's both. Okay.
It is both.
Yeah, it's both.
Yeah, it's both.
Right, so they have a sort of a debt strategy, like they have a whole team of accountants and tax lawyers, right, to kind of, who look at the current laws on the books for the IRS, because the rules change all the time, depending on who's in office, right? So they say like, hey, tax cuts for corporations, Trump's in office, tax, you know, and then you'll be like, oh, get all the debt you can, right? You know, and then they'll say, oh, Biden's in office, they're coming back, and then they put a new law out, right? And now the tax base is higher. So it's like, oh, let's make sure we pay all of our creditors now, before we didn't have to, right? Before take all the loans you can and just utilize it. So it's a lot of politics involved, but it really is both, right? It's a strategy, depending on what's going on right now with the IRS, right, and your creditors. All right, with the income statement, revenue increases in the firm's assets that result from activities and earned income, right? Remember we say, even when you file for taxes, they're looking at earned income. You're like, hey, Mr. IRS, you know, by the way, I sold drugs on the side and I made $50,000. Well, that's not earned income. So they're not gonna tax that. You know what I'm saying? earn income, things you have from a legitimate operation, right? Put in simple terms, right? The assets that that result from activities that intended to earn income. And expenses are resources that are used up as a result of business operations, right? So we're just kind of looking at it from the different point of view. We're like, well, I have this debt as a company because I consider it a resource. And I need it in order to operate the business successfully so that I can make more revenue. Right? So here we're just saying it's resources that are used up as a result of business operations. And then net income, right? The difference between revenue and expenses in a given time period. And typically we just say net income will be profit. And then cash flows. This is the third and I think the last one we talked about. Statement of cash flows, right? So identifies the amount of cash that flowed in and out of a firm from the following type of activities. From operating activities, which are just the sales of goods and services, which we actually sell, what do you produce? Investing activities, sale of fixed assets and financial assets, bought as long-term investments. What could be some examples of this? Fixed assets and financial assets.
The problem. You said the problem first?
No, what could be some examples here? Cash flows from investing activities, right? Sale of fixed assets and financial assets. What are some fixed assets and what are some financial assets?
It differs from business, so.
Yeah, just throw some out there.
I wouldn't say it's money, but the fixed price on an apple orchard is significantly higher than a banana orchard.
But just think,
So the investment put into that was $100,000, but the banana investment was $50,000. So it's like, so if they were to sell that off, that apple orchard would be still worth, as one of their assets is $100,000 investment.
okay, so that could be a financial asset. But think fixed assets is like, yeah, I sold the building. We had, my company owned this big manufacturing plant, right? We don't really use it anymore. Sold the building for $75 million. You're like, oh, you sold your fixed asset, right? It's fixed, right?
So something you own.
Something you own, right? Financial assets would be like, hey, we created 10,000 new stocks, and now we sold the stocks. That would be a financial asset, right? We created bonds. Bond is debt. It's like, hey, give us some money and we'll give you this piece of paper that says we'll pay you back this money at this date, right? 6-month coupon rate, 6-month bond, 3-month bond. So essentially companies can create debt from thin air. We're like, hey, how are we gonna raise money? We're about to go broke. Let's create bonds, right? Let's create some debt, put it on the market, see who actually buys it, right? $10,000 bond in 3 months, which means we'll pay you back $11,000 in 3 months, right? With a 10% coupon rate. So those would be financial assets. Financial assets, you're selling some stocks, you're selling some bonds, you're selling something of the sort. Right, issuing additional shares of a firm's own stock or from taking out short-term and long-term loans. Loans would also count as well as that too. All right, we got a few more other statements. Statement of return earnings, right? It's a simple statement that shows how retained earnings have changed from one accounting period to the next. Typically it deals with more of the owner's equity, primarily, which is part of the equity statement. It shows how net income and dividends affect retained earnings. And we know what dividends are, right?
No.
All right, okay, so for example, if you say, hey, I wanna buy a stock that pays dividends, right? Not all companies pay dividends in their stock. We say, hey, this company gives money back even though the stock goes up over time. Remember I said some people, I know quite a few people, they're like retired and live in Florida, and they make a few $1 million just off dividends. So literally they own stock from particular companies, right? And the companies pay out extra money. So it's a payout, right? Let's look up real quick to see the largest companies that pay the largest dividends, so we get an example of what it is.
Usually those stocks are more expensive, right? Because they-
Sometimes, yeah. All right, Verizon pays them out, AT&T, Walgreens, well, that's not Walgreens, it's something else. Ford, Hasbro, Dow. So there are several companies. There's not even, there's tens of thousands of companies that pay out dividends. So that's also another, think of just a personal investment strategy. You could say, hey, I could live off the dividends, right? Not only is the stock going up every year, my net worth is going up, but I also get actual cash from my dividends. All right, some methods used by stakeholders to understand companies' financial statements. You get a CPA, right, certified public accountant, to perform an annual external audit, right? So you can hire a CPA, you check notes to financial statements. So you read financial statements, normally they'll have a side column that gives some sort of commentary about why things in one category has changed. And look for some trends when you compare the statements together. So we got a horizontal analysis, right? This is one of your first ones, which is financial statement that compares account values reported on the financial statements over 2 or more years to identify changes in trends. All that's looking at is from one time to another, right? So you're looking at from 1 year to another year, how things change, how the revenues have changed, right? How the amount of debt has changed, sales has changed, all this stuff. So you can compare and see some of the trends. Are things going good? Are things going bad? And the auditor's report, but we'll kind of skip all that. All right, notes to financial statements. Disclose additional information. Let me see. Budgeting. Management tool to explicitly show how a firm will acquire and allocate the resource needed, which is extremely important. Think of just yourself. You do personal budgeting, right? You only gonna have so much money, so you really gotta find the best ways to use the money that you have in a period of time. So you set yourself goals over a period, specific time, same as companies, and that's how you plan. So you plan your life by looking at your goals with the amount of resources that you have. All right, so the marketing department in a company only gets such amount of money approved by the finance department, then that's how they will plan their goal or process, and they'll have a limitation. A limitation be set by the finance department, how much money they're actually gonna be able to give the marketing department, right? So you have to plan that process, and that's how you're gonna achieve goals. Encourages communication and coordination amongst managers and employees, right? Talking about what you have and what you don't have in terms of resources. Serves as a motivation tool, which is basically just means a challenge to do something with the limited amount of resources that you have. Are you creative enough to do all this stuff with what you've allocated to have in terms of resources to do it? And it helps managers evaluate progress and performance. All right, so we got operating budgets, right? Communicating an organization's sales and production goals and the resources needed to achieve them, which is essentially saying all the things that we use in order to generate revenue, right? The actual movement of goods and services that we sell, that's where your operating budget comes from. looking at all the resources, whether it's technology, whether it's people, amount of people you need to get this stuff done. Maybe it's the physical location itself to get it done. Maybe it's the machinery to get things done, so that'll be part of your operating budget. And then financial budget. Focus on the firm's financial goals and identify the resources needed to achieve them, right? So if you have financial goal of buying another building, right? Or buying another store, if you're a retailer, you say, hey, we wanna buy 5 more stores in 5 years. Right? So now you gotta set a financial budget, and that'll work with your goal in terms of reaching that goal with the resources that you currently have. And then master budget, which represents the firm's overall plan of action for a specific time period, which just means typically companies own 4 quarter periods, right? You say Q1, Q2, Q3, Q4, right? Right, so we say January, February, March, Q1, right? April, May, June, Q2, right? July, August, September, Q3, October, November, December, Q4. But for each one of those, say, quarters, we have an overall plan of action, right? What do we hope to achieve in Q1, quarter 1? Right? What do we hope to achieve by the end of the year? Where are 5 things, maybe? All right, so we got top-down budgeting and bottom-up budgeting. Right? Top-down is top management prepares the budget with little or no input from middle or supervisory managers. So basically, you're not taking input from your managers below. You're just setting aside money based off what you have, right? Which may not be the best. Maybe you need input from your managers because they can say, hey, if we have just a little bit more money here, we think this will translate to more business, more sales or something like that. Whereas bottom-up budgeting is middle and supervisory managers are allowed to participate actively in the creation of a budget, right? So you get your operating managers, your marketing managers, they put in all their input to say, if we do this, we think this translates to growth, right? Therefore, give us X amount of dollars so we can make this actually happen. So here is just an illustration of development of a master budget. So we got our sales budget, right, to get things sold. And here we got a production budget and a selling and administrative and expense budget, which just means the people involved in selling, say selling managers and things like that. So here on the production side, we got direct labor, direct materials, and overhead costs, right? So what is overhead? What are some examples of overhead?
About overhead for the necessity or?
Yeah, typically overhead is something you absolutely need for the business, right? That doesn't go directly into selling it, of course. Like selling it would be like the actual product we're selling. We gotta get it from a supplier so we can sell it, change the price. But overhead, think of Dominican, think of Palmer Hall, right? Overhead would be, hey, Professor Ross, you know, you need electricity to turn this equipment on. Right? So you need electricity, or what we would call utilities. You need a few more things, right? You need water, supply water, supply this, supply that. Right? So we say like extraneous things. Question.
Thank you.
Direct materials mean just the raw materials needed to do what we need to do for production, and direct labor would be people actually working on, say, the machinery or whatnot. And then we'll have a budgeted income statement from all of that. And past that, we get our financial budgets, right? So we how much cash, how much capital, and we'll have our budgeted balance sheet. Then we got a static budget, right? Created based on the assumption that there is one single level of sales, which is real world sales vary considerably from the forecasted value, and the figures become inaccurate. So think of this, when we do projections, when you say like, hey, I'm trying to create accurate projections of what sales will be, typically you'll look in the past and see what you sold either last quarter or last year. You'll look at maybe the marketing budget to be like, okay, we've given you X amount of dollars, this should translate to X amount of more sales for next year or the current time period. And those numbers are never the same. So projections are never really accurate that much, right? You could make them more accurate. But here we're just saying static budget is real world sales, vary considerably from the forecasted value and the figures becoming accurate. So we have a flexible budget, which is developed over a range of possible sale levels and appropriate budgeted level of costs, right? So we're just kind of flexible of how things could go. And so we give a different range of possible levels of budgeting costs. All right, and financial and managerial accounting, right? Two separate ones. So when you go on the business program here, if you continue and be like, hey, I want to major in business, marketing, management, whatever, eventually you're gonna have to take financial accounting and you have to take managerial accounting, right? It's required. It's a requirement. So what's the difference, right? What is the difference? Financial accounting is primarily intended to provide information to external stakeholders. So think of financial accounting as for people outside the business itself, right? Like for stockholders, stakeholders, maybe government agencies, right? Creditors, right? So they want to look at this, but they're not involved in the operations of the business, but they're just outsiders that need this information, right? Or the general public needs it if they own stocks in these companies. Whereas managerial would be intended to provide internal stakeholders such as the managers and its departments to help them assist in making decisions, right? So one is way on the outside for people to look in and speculate about things. The other one's internally so that the people inside the business can make good decisions to run the business. All right, and the types of information presented focuses almost exclusively on financial information. You're just looking at a bunch of reports, right? Yeah, they have a lot of line items and they're itemized, but most of it is just a bunch of numbers. Whereas managerial accounting may have some non-financial information, right? Some commentary about some activities in the business that we need to pay attention to help us make good decisions. And then the nature of these reports for financial prepares a set standard of financial statements, whereas managerial, we prepare customized reports to deal with specific problems or issues. And the timing is usually quarterly or annually for financial, whereas for managerial, they're created upon request. So executive can request a specific financial statement about one part of the business if he needs to make some sort of decision about something. And then the adherence to accounting standards, financial accounting governed by GAAP, right? And managerial, not really required to follow GAAP, right? This is when we set it out for the public or the government to see we want to have these principles, but internally we don't have to follow them. We could do kind of things our way. Just looking. And in time period, summarizes past performance and its impact on the firm's present condition for financial. And for managerial, provides reports dealing with past performance, but also involves making projections, right? We're always constantly thinking how much sales we're gonna have next year, next quarter, right? All these sorts of things.
Professor, when people talk about quarters, it makes me sound like the school system, quarters. Is it similar?
Yeah, absolutely. Yeah, things are broken up into 4 quadrants, typically because I think it's just better to human beings to manage a shorter period of time than things abroad. It's also better for us to analyze performance over quarters. So we can say like, did I do crappy that last 3 months? Did I do great the last 3 months? And think about it too, 4 seasons in a year, right? So you say there's this thing about 4 when it comes to time. You have 4 seasons a year, typically every 3 months, there's a new season that comes around, right? So things change, which means there's only certain things we can do at a certain time, right? People aren't buying ice cream in the middle of December like they would in July. So things change. All right, types of costs. We got out-of-pocket costs, involve payments of money or other resources. Think about this: if you didn't get a loan for school, if you didn't get a grant, then you paid out of pocket, right? Implicit costs arise when a firm uses owner-supplied resources. And fixed costs remain the same when the level of production changes within some relevant range, and variable costs vary directly with the level of production. Kind of two major key things I would say take away from that is fixed and variable costs. For those of you who've never taken accounting, right? Never taken accounting, two big takeaways. I'm telling you, pay attention for anything, any decision that you make. Like fixed costs is something I'm guaranteed I know how much I'm paying. Variable costs are like, this is risky. This could change if something changes. Right? Think of that. So even when we talked about cars, so there seems to always be a sort of discussion on, hey, how should I go about buying a car? Professor Ross, should I finance the car, pay a monthly note? Should I lease the vehicle because I have no reason to want to own this vehicle, right? Or should I just buy a car outright because I think it's the best deal? I don't have to worry about paying every month or be obligated for 72 months, 64 months, whatever the case may be. Right? And so you say one is fixed, right? You buy a car outright, it's fixed. That's it. You don't have to pay nobody enough. Pay no money, right? One is variable. Like, okay, I'll buy this car, I'll finance it, but after a certain amount of time, this car's gonna start acting up and going bad, and I'm still gonna have to pay. Regardless, if the car breaks down, if the engine fails, right? And so you say that was more variable cost, whereas leasing, I would still say it's fixed, because it's short term. So that's just kind of one way to think about any of these things. All right, then we got direct costs incurred directly as a result of some specified cost object, which means direct costs. Meaning, like if you're selling something, you have to get it from somewhere, right? Somebody supplies it to you, that would be a direct cost. Whatever you pay for them, for you to be able to sell it to others, is a direct cost. And then indirect, result of a firm's general operations and are not directly tied to any specified cost object. What could be an example of an indirect cost? What's an indirect cost? Like you had a business, you're making a run, you're selling something. Right? What's something that's kind of indirect and has an indirect cost component to it?
Gas for travel.
Yeah. Yeah,
I think
absolutely.
the same thing actually.
Yeah, you know what I'm saying?
Office supplies, those kind of things.
Yeah. You're like, man, the indirect cost would be like, well, I need to be able to take your money, so I need to have like a point of service system, like Square, whatever the case may be, right? And like, not only am I selling you something, but indirect costs would be like, okay, I need to be able to get your money in some way, form, or fashion. Maybe have a cash register, right? All right, we'll end off here. The discussion board is put up for us to put our stuff on. Let's try to have it done by Thursday. So everybody put your ideas on there as soon as possible, and then vote. Say, I want to go with this idea. So we can take care of that Thursday. We'll move on to the post.
We vote with the compliance.
Yeah, there's all discussion board that's replied. Put your idea, and then if you already see a company that you want to vote for, go ahead and say, I choose this company.
Companies that, or is it group?
These are going to